Are you trying to figure out whether to invest in ETFs or index funds, but keep running into conflicting advice? You're not alone. For beginners, these two investment options often seem almost identical, but they're not quite the same. Understanding the key differences can help you make smarter decisions with your money. In this video, we'll break down exactly what ETFs and index funds are, how they work, and which one might be better suited for your investing goals. Whether you're just starting out or looking to refine your investment strategy, this guide will give you the clarity you need without the jargon or hype. Let's start with ETFs, or exchange-traded funds. An ETF is a type of investment fund that's traded on a stock exchange, just like an individual stock. When you buy an ETF, you're essentially buying a small piece of a large basket of assets, like stocks or bonds. For example, the SPDR/S&P 500 ETF, ticker SPY, holds shares from 500 of the largest U.S. companies. So by buying just one share of SPY, you're instantly invested in all 500 companies. NNTHE. Big advantage of ETFs is flexibility. You can buy and sell them throughout the trading day at real-time prices, just like stocks. That makes ETFs great for people who want more control over when they buy or sell. They also tend to have slightly lower expense ratios compared to similar index funds, which can add up over time. NNHOWEVER. Since ETFs are traded like stocks, you may need a brokerage account that allows real-time trading. And if you're not careful, you could rack up trading fees, though many brokers now offer commission-free ETF trades, especially in the US. Now, let's talk about index funds. An index fund is a type of mutual fund that aims to match the performance of a specific market index, like the S&P 500 or the total stock market. Just like an ETF, an index fund gives you instant diversification by spreading your investment across many companies. NNTHE. Key difference? Index funds are not traded throughout the day. Instead, they're priced just once at the end of the trading day. So if you place an order to buy or sell shares of an index fund, it will be processed at the fund's closing price that day. This makes them less flexible than ETFs, but also less tempting to trade impulsively. Many index funds are ideal for long-term buy-and-hold investors. They're often available through retirement accounts like 401ks or IRAs, and they usually come with automatic investment options. That's great if you're trying to build a disciplined, hands-off investment plan. NN pros of index funds include NN simple to use and manage in great for dollar-cost averaging and automatic investing. NN no need to worry about intraday market. Swings and cons include NN less flexible than ETFs. May have slightly higher minimum investment requirements and can have slightly higher expense ratios depending on the fund provider. So what does the research say about ETFs versus index funds? No 2022 study by Morningstar, a leading investment research firm, analyzed long-term performance of ETFs and index mutual funds that track the same benchmarks. The result? There was no consistent performance advantage for either type over the long run. In fact, returns were nearly identical when fees and tracking differences were accounted for. Another report from Vanguard, one of the largest providers of both ETFs and index funds, found that investor behavior often matters more than fund structure. In other words, how consistently you invest and how well you stick to your plan tends to have a bigger impact on long-term results than whether you choose an ETF or an index fund. NNTHE takeaway from the data is clear. Both ETFs and index funds are low-cost, diversified, and effective tools for long-term investing. What matters most is choosing the one that aligns with your personal habits and staying consistent over time. NN. So what should beginners take away from all of this? First, both ETFs and index funds are excellent choices for building long-term wealth. They offer broad diversification, low fees, and exposure to the overall market without needing to pick individual stocks. If you prefer flexibility, want to buy and sell during market hours, or plan to make lump sum contributions when you have extra cash, ETFs might be a better fit. Just make sure you're using a broker that offers commission-free trades and no minimum balance requirements. And on the other hand, if you want a set-it-and-forget-it approach with automatic investing and minimal decision-making, an index fund could be the smarter route, especially if you're investing through a retirement account like a 401k or Roth IRA. Here's a quick summary. ETFs, traded like stocks, often slightly cheaper, great for active brokers or lump sum investing in index funds. Simpler, priced. You don't need to choose perfectly. Many investors use both, depending on the account or situation. The most important thing is to start investing early, keep costs low, and stay consistent. And there you have it. ETFs versus index funds explained in a clear and beginner-friendly way. In NIF, you're just getting started. Don't stress too much over which one is better. Instead, focus on building good investing habits. Choose a low-cost, diversified fund. Invest regularly, and avoid emotional decisions. Whether you go with an ETF or an index fund, you're already ahead of the game by focusing on long-term investing and avoiding high-fee, high-risk strategies. Netanju. This video helped you understand the difference between ETFs and index funds. Give it a thumbs up so more people can find it. And if you're new here, consider subscribing. We break down investing concepts without the hype, just like this. Got questions? Or are you already using ETFs or index funds in your own portfolio? Drop a comment below. I'd love to hear what's working for you. Thanks for watching, and I'll see you in the next one.